Very much, and everybody, welcome to our panel discussion on venture capital and health equity, exploring trends in digital health investments. I think, as we all know, the pandemic really ushered in great interest, adoption, and investment in digital health. And in fact, if you look at digital health investments, as some of our panelists are going to talk about, we've actually crossed the $20 billion mark so far in 2021, which is setting records. There are a lot of focus areas for a lot of this investment, including mental health, oncology, the cardiovascular space, diabetes, and other chronic diseases. And so the investment landscape looks really very promising, at least so far this year, and likely into next year. But as we know, there are longstanding issues with regards to health equity, regarding the health system as a whole, which obviously are going to impact digital health and digital health investment. So our panelists are going to walk through what the digital investment landscape looks like with a particular focus on health equity issues and underrepresented founders. So I'm going to turn it over now to our first panelist, who's going to be Megan Swide from Rock Health.
Thanks, Renee. Thanks for having me. It's so great to be on and really excited to hear from my fellow panelists as well. I'm going to talk a little bit about that funding boom that Renee was just referencing, and then also just touch really briefly on a couple of lenses through which we view health equity. So if we flip to the next slide, just to give super high level overview, a little bit on me as well as Rock Health. So we continue to be active investors, early stage investors in digital health. Through our nonprofit work, we're convening community. Maybe some of you have attended Rock Health events, really excited to do even more of that, hopefully in person in the coming year. And then we also advise large scale enterprise healthcare companies. So connecting them into the innovation ecosystem, offering them market insights to advance their digital health strategies. And some of what we do on that side is our thought leadership and research, really tracking the venture space. So if we go ahead and flip to the next slide, this is really showing that rapid increase that we've seen over the past couple of years, and especially over the past 9 months or so. I feel like I put up this slide and the slide kind of does the talking for itself, right? There's been a massive influx in terms of capital going into, this is looking at US-based digital health companies. As Renee said, even when we just looked at the data through Q3, already seeing over $20 billion invested in the space. Obviously, the pandemic has really accelerated, whether it's reimbursement, regulatory paradigms that are accelerating this, but I think also just a recognition among enterprises as well as consumers that there's so much opportunity here for virtual care delivery, for software to transform really every part of the healthcare business. And when we look at these numbers, we do like to think about, what is being invested in, who is doing the investing, and who is building these solutions. So the two lenses that I wanted to bring forward from an equity perspective, one is, who are these products being built for and ultimately impacting? And then two is, who is doing the building? So who are the leaders leading the development of these solutions? I think those two questions are really important to unearth some of the disparities that we still see in healthcare. So the next slide is admittedly kind of an overview of some work that our consulting team did over the summer. We stand on the backs of giants who are really, really deep in health equity, and we are very much learning from those digital health leaders who put equity at the center of their business models and really have on the ground experience developing culturally responsive, accessible digital health solutions. From our conversations with that group, a few kind of key lessons emerged in terms of how innovators, whether in startups or enterprise, can orient themselves around equity. One is centering in the community. Trust is essential to building solutions that are going to work for populations, figuring out the communities you want to work with, understanding what might be driving past and current distrust, and then understanding their goals in relation to their health and well-being. I think co-designing the solution is so important, building with populations, not for them, developing the right tech. So the technology, the algorithms, devices that make kind of personalization and virtual care at scale possible often are limited by bias in their data sets and calculative models. So making sure that you're bringing that mindset and understanding that and weeding that out. And of course, making it accessible. I think sometimes we think about accessibility just in terms of the devices and the internet, but it's also, it's digital literacy. It's kind of the accessibility of those devices when care is needed. And so really thinking through accessibility from a ton of different angles. So just a couple high notes in terms of how we think about equity from a building standpoint. The next slide shows a little bit about how we're thinking about equity from a leadership standpoint. So who is being funded and who is developing these solutions. So last year we partnered with Dr. Ivor Horn on a diversity in digital health research study where we tried to understand who's building solutions, who's getting funded, and how do we look at that from an intersectionality lens of gender and race and where people live and how that impacts funding. So what the data is showing here is we essentially surveyed 253 founders in the digital health space. We did ask them for demographic information, and we also asked them, okay, as you're building your digital health company, are you venture backed? Are you angel backed? Or are you bootstrapping your company? And what we found is that, as you can see on the left, which is the men founders, men were more likely to be venture backed than women. Than the women founders, and white and Asian men, as you can see, were the most likely to be venture backed, particularly relative to Black women who were the least likely. And so you can see how this intersectionality lens is really important to take when you start thinking about who has absolute access to the capital, the tools, the networks that are going to make budding entrepreneurs successful. And I think as investors, as part of this ecosystem, really important for us to think about how we create that broad support and access. I'm sure I'm like well over my 5 minutes and want to hear from the others, but just wanted to offer this food for thought. We actually are seeing the highest portion of women founders ever being funded this year. I think it was 19% as of Q3, still a really small portion of overall funding. Their average deals, the average deal size that women founders are raising is lower than men. I think that has to do with the fact that women tend to be running earlier stage companies, at least at this point. That's what our data is telling us. But there's a lot to unpack here, as you can imagine, in terms of just accessibility. I think if you could bootstrap a company, more power to you. But when you think about how to scale in healthcare, access to that capital can be a real make or break for success here. And I'll leave it at that.
Great. Thank you very much. I understand that some people can hear me. Can everybody hear me now? Great.
You sound good.
Great. Lisa, you're next.
Hi, everybody. Thanks for the opportunity to address you today. I wanted to talk a little. I'm with Manat Phelps and Phillips, which is a consulting and law firm, and so we work in and around business strategy, including equity areas, quite frequently. And so I'm really interested to hear what everybody has to say. I also lead Manat's venture fund and have been in venture in the healthcare world for over 20 years. So it's an area I've seen with interest and watched with interest. And I think, the thing that people don't often talk about is how there is an inherent tension between venture capital and serving certain populations, especially small populations or narrower populations. And that plays a big role, I think, in what ultimately gets funded. There's some exceptions, and I'll point to Andre as a difference. But in the bulk of the marketplace of venture investors and entrepreneurs too, I would say that they generally tend to clump with people like them and think about people like them and build products for people like them. And it's amplified by the fact that so much is built in California and New York. So it really leaves out large swaths of population. And a lot of what's going on right now relies on AI and other areas of technology that are built on data, and those are inherently biased from the start. There was a book that just came out about the bias in data and how that affects women fundamentally in the US, and it's pretty profound, worth checking out. I'll get the citation for you in a bit. But this is kind of an insidious way that products don't serve markets well, and I'm sure the same is true of people of color and the like. There's really an inherent tension between low market opportunity, or what's perceived as low market opportunity. Some of the areas where this hits, for instance, is in rare disease and in pediatrics. People perceive them as small markets and thus not worth investing in. There's some exceptions again in certain biotech areas, but oftentimes products and services, particularly tech products and services that are meant for these populations, struggle to get funding attention. And there's also a very significant inherent tension inside of companies between building for the biggest audience and building for the specific audience. Young companies really struggle to focus, and they get told to focus, and they have to put their money where their biggest opportunity is, especially in the early phases. And this really often drives them away from products and services that are for subpopulations, specific populations, as they try to do sort of the lowest common denominator that doesn't really work for everybody in the marketplace at all. There's also a funny tension that happens with funds. That there have been funds out there, and I'll call California Healthcare Foundation out as one that's been really good at this, of giving companies money in order to specifically fund initiatives to serve underserved populations, whether it's people who speak Spanish or people of different races or what people on Medicaid or what have you. And I've seen firsthand as an advisor to that fund over the years that that's a really tough model, because companies take that money willingly and happily to do those things. But if they have a moment that's a glitch in their life on their core business where they started, they're going to refocus there. And that money's going to head there. And they're not going to be able to spend the attention and the time on the things that were the more mission-oriented efforts. And it's really gotten in the way, I think, of companies expanding services that could be really valuable across different communities. So I think there's ultimately just a big tension here in this world between what is needed by people and what can get paid for and what will get funded. And we don't talk about it very openly, but it's the truth. And so things don't get funded because people can't make enough money doing it, or because they don't have enough money to do it. And it underlies some of the challenges here. So just wanted to put that out there.
Thank you, Lisa. Very interesting. I'll come back to you with a couple of points during a Q&A. Michael, you're up.
Thank you. Michael Penn, founding partner of Health Equity Ventures. And Lisa, thank you for your comments. Right, both Megan, the points that Megan makes about who's absent from the innovation ecosystem in healthcare, and Lisa's points about these tensions is exactly why Health Equity Ventures exists. So we are a venture and advisory firm focused on creating opportunities for the most vulnerable populations in healthcare, leveraging innovation. But there's a lot between here and there. And so the combination of venture and advisory is important, because closing the gaps requires more than capital, right? And I look forward to Andre's comments following, because this requires just a different set of expertise and insight. And you'll notice the redwood trees in the background here. And one of the taglines for Health Equity Ventures is growing together. And so to make progress on serving and addressing needs in vulnerable populations, we need everyone, right? So we need traditional investors to understand more, right? So there's a literacy piece to educating the broader healthcare digital health ecosystem around what opportunities exist and dispelling myths. And ultimately, I also want to reference, so the reason I mentioned the redwoods is because individually a redwood tree has very short roots, and it can get blown over or toppled very easily by wind, et cetera, the elements. But underneath the soil, their roots intertwine and interdigitate and fuse, creating a stronger base, right? And so by growing together, the idea behind our thesis is that we can create more equity and more opportunity. The last thing I'll say as it relates to, so we certainly have a special focus on underrepresented founders, whether that's race, ethnicity, gender, sexual orientation, income, socioeconomic status, where you came from, the insights. People build companies based on things they know and things that they care about. And so when you have large groups generally absent and not having access to capital, that does two things. It, one, reduces the solution sets that are available. And we all recognize that healthcare needs as many different solutions that can be tested, right, as possible. And so I'll finish by quoting or talking about a study that was done several years ago now in the Proceedings of the National Academy of Science. And the question was, how do diverse problem solvers ultimately create value? And so I talked about the first piece, which is different solution sets entering the marketplace. But the other point is that the ways that diverse problem solvers think is different. And so the combination of a different solution and a different way of thinking and approaching problems creates a synergy. And so that's the fundamental basis behind our thesis. And I know, look forward to hearing from other people on the panel, but tremendous opportunity, but complex in terms of realizing it.
Thank you, Michael. Much appreciated. Andre, you're next. And I think you have some slides for us too, correct?
I do. Yep, I'll breeze right through them. And thank you for whoever is clicking through the slides for us. Andre Ostrovsky here. I am the managing partner of Social Innovation Ventures, practicing clinician, pediatrician, and spend most of my time investing in diverse founders that are trying to close health equity gaps. And what I want to briefly remark on is this notion of the bottom of the pyramid. And I want to take a realistic approach to investing and addressing some of the impediments to investing and innovation that the other panelists have described. And next slide, please. So this notion of the bottom of the pyramid was described by Professor Prahalad almost 2 decades ago, which is the notion that the folks at the top of the proverbial pyramid, or the purchasing power pyramid, there's not a lot of them, but they have a lot of purchasing power. And that's unfortunately where the vast majority of healthcare innovation is targeted, whereas the majority of the disease prevalence and importantly disparities in disease prevalence actually happens at the bottom of the pyramid, which is where folks have limited to no purchasing power. And if we look at the bottom quartile, that is almost equivalent in terms of total addressable market as the top of the pyramid. And so for innovators, for investors, folks that let's say take a purely financial view, the opportunity to make money is absolutely there at the bottom of the pyramid. And if you look just a whiff above the bottom of the pyramid, it is far bigger than the opportunity to make money at the top of the pyramid. Next slide, please. What I fundamentally believe is that we cannot frame investing in health equity as a social issue. Investors are optimizers. Investors almost universally are not out to have social impact. They're out to make returns to their limited partners within a 10-year fund lifecycle. And I sit here in a firm, a VC and private equity firm, where I'm visiting for a board meeting of one of my portfolio companies. They're great people. They're really good humans, but their objective is to optimize return on equity. And so our job, I believe, as innovators and investors in the space, those of us on this panel and others interested in the space for social reasons, our jobs are to demonstrate financial returns by investing in the bottom of the pyramid or by investing in other populations that are marginalized or vulnerable in some other way. And my investment thesis has been that investing in the bottom of the pyramid can lead to outsized financial returns, which I'll get to in just a moment. But a couple of best practices that I'm seeing emerging, which I think mirror, Megan, what your report highlighted really nicely. If we go to the next slide, one of those best practices, and probably the single differentiator of my approach to investing, is I invest in people who are different than me. This is just a sample of the founders I've invested in. Next slide, please. Another best practice is, I think Lisa, you may mention this, and Megan, this was on one of your slides, having board members and senior leaderships at the companies, at the funds, immerse themselves in the journey of the client. And it is essential that they feel the challenges, feel the pain. Granted, you can only walk in the shoes so much without actually like living that experience. And this is an example where a colleague of mine who's also an investor, we spent a 24-hour period being homeless. I mean, in quotations, we knew we had homes to come back to after this experience, but it was very eye-opening. It had pretty significant implications on some of the process improvements for housing insecure populations when I was running a series of methadone clinics. Next slide, please. Another best practice, invest in evidence early. This is just a sampling of some of my portfolio companies, and not portfolio companies, friends companies, Propeller, for example, I'm not an investor in, but they've done an incredible job investing in research, proving what they're out there marketing, as opposed to what is the norm, unfortunately, and that is companies will just make a marketing claim and have absolutely no evidence to support it. And it doesn't always have to be randomized controlled trials. You have to start somewhere. And so the latter two studies, one is a retrospective cohort study. Fine, it's not an RCT, but it's something. It's published in a peer-reviewed setting. Aspirations to publish in a peer-reviewed setting really should be a goal and expectation that we investors and board members have of our innovators. Next slide, please. I would also say that it's essential for us to recognize software, unlike our friends at Andreessen and Horowitz say, will not be the solution, right? It can enable the solution. It's a human connection. It is a service intervention. And it's very rare that a pure software play is going to make a meaningful difference. Having said that, I have a couple of investments in straight up software plays. I think it is possible, but the vast majority of impact is not going to be software alone. Next slide, please. And the proof is in the pudding, right? I mean, this is not statistically significant sampling frame, but just in the past 3.5 years, out of 26 investments to date, 15 or 58% of the founding teams are diverse, 12 or 46% of the companies raised their first institutional round since my fund's involvement. Not that there's causation there, but there is a level of de-risking when someone like myself or someone like Lisa or someone like Michael are first money in. Institutional investors will then say, oh, okay, there's a there. 3 exits to date, and internal rate of return net of fees 41% with a return on equity of 301%. I'm outbeating traditional venture investors by investing in diverse founders. And not to create an analogy with our investor colleagues as sharks, but sharks sniff out blood in the water. We need to show them that there is money to be made in the bottom of the pyramid. And so far, I've had some pretty good returns. I'm hopeful that institutional investors follow suit. Thank you.
Very interesting, Andre. Just to follow up with you there, you talked about the bottom of the pyramid and your belief that there's money to be made at the bottom of the pyramid. Why don't other investors understand that? Are we talking about implicit bias issues? What are we talking about?
Think of what most investors look like. And I'm oversimplifying this, but I respect the folks I'm with, but I just came out of an all white male board. Every time I'm the squeaky wheel, guys, I know our board is full, but really, like, I literally said, like, I will give up my seat. The perspectives that the board members bring and the investors bring are inherently biased by their experiences. White guys, generally growing up with a whole lot of privilege, have a very different lens and limited lens than a whole lot of other people. And I think that is probably the main driver, Renee. I think there's other variables as well. Like strategically, yes, it is easier to go to do a direct-to-consumer play, or even to go for a company that's doing a B2B or B2B to C play that's going after employer-insured populations, as opposed to Medicaid first. That is a sound strategy, as long as the North Star is equitably going after Medicaid as well, equitably going after duals as well, immediately after your business model is proven out in that higher iteration, higher unit economic environment of employer insured or direct to consumer. There's other variables, systemic racism beyond just who is the money coming from. I think if we tackle just those two, we're gonna move forward way faster.
Now, before I have others weigh in, I want to let the audience know that if you use your Q&A function You can submit questions, and then hopefully we can get to them sometime during this panel. Does anybody want to react to what Andre said? I know, Lisa, you sort of touched on a little bit of this in your talk. What is your reaction to Andre's comments there?
I mean, we see it all the time, right? People, the problems they recognize and will choose to solve are most often the ones they experience in their own life. So they're not often even aware of the other problems that need solving. And when you, despite, mountains of research that shows diversity of all types leads to more profitability, there's something that prevents that from happening in management teams and boards. And frankly, there's so many ways to solve that now. This argument that, well, I just don't even know where to find the right people doesn't fly for me anymore. It shouldn't fly for anybody, because there's a lot of places to find people who are more diverse than oneself, if one is a young white man. I'm, perennially frustrated by it. I've been kind of banging that drum for a long time. And I think that for some reason, the financial arguments have not held water with the folks that they should. I'm not. Maybe it's too hard to believe that diversity breeds better financial outcomes, but there's been an awful lot of research that demonstrated. For the life of me, I cannot figure out why that doesn't move mountains on this front.
It's interesting. Michael, any reaction to Lisa's last comment?
Yeah, no. So it is hard. I guess what I would add to that is, as I've been out raising capital, so we hope to have our first close probably in the first quarter of next year, talking to limited partners, right? Institutions who will invest in health equity ventures and understanding their responsibilities and accountabilities, right? And so part of the challenge is institutional investors are incredibly risk averse in any way, right? A new partner is a risk to a fund, right? A new investment thesis is a risk to a fund. And so what ends up happening, right, is that the incentives and the historical way that risk has been managed doesn't leave a whole lot of room. And so it just makes it so much easier, right, for the white men to make convenient or easier choices, right? So there's no incentive in the system for them to make different choices at scale, right? And so it just drives home, I think, the value of the Andres and the Lisas and the CHCFs and the health equity ventures, because there just has to be more activity, right? More things to point to, both for our peer investors and then the institutional limited partner investors. So it's slow.
I think the hope lies in the limited partners in the end, because if you look what's happening in the public markets, and public markets tend to be a leading indicator for the venture markets in many ways. We're starting to see institutional investors be very aggressive, and appropriately so, about seeing diversification on boards, diversification management, equal pay issues being addressed. Now we're starting to also see things like ESG considerations, climate, whatever, all those good things. I don't mean whatever to dismiss it. I mean a broad array of things. And my hope is that we'll start to see that come now down to the venture world over time, as limited partners who are participating in the public markets and who are big investors, in endowments and the like, from endowments and the like, will start to think about their venture portfolios similarly. And as the LPs put pressure, the investors in the funds, so will go the funds. And when the funds go, the companies will start looking to solve those problems. So I think it's going to come more from that direction, is my guess. And in addition to we've seen now lots of interesting young entrepreneurs and startups addressing different problems and who have different looking groups of people associated with them. I think their biggest challenge is going to be finding that Series A, Series B money. But hopefully those two phenomena will converge at some point in the near future.
Really
Great.
quickly, if
Yeah.
I could just echo what Lisa pointed out with an example. I have a business I've invested in. It's a service business, so it's not tech, but it has a pretty significant impact on health equity, and that narrative being woven into the bank book for sellers, for buyers, for private equity firms to consume, has led to a very healthy multiple. And the transaction not closed yet, but the entire theme of the acquiring private equity firm is an ESG theme. So it is beginning to happen outside of just the public markets. And what'll be interesting is like how quickly will it get down to the venture level. And I think the more we can celebrate, as Lisa's pointing out, LPs that are having that type of prioritization, the faster we'll be able to see some real change. Thanks, Lisa, for bringing that up.
Great. And so, Megan, I want to go back to you about one of your slides, but before I do that, do you have any reaction to the discussion so far?
Yeah, there's a ton to unpack, and I often bring this up, I'll bring it up here, but it was really powerful for me to read a study, I think it was a couple years back, that Harvard Business Review put out just about some of the implicit bias that really can impact the outcomes that we're talking about in terms of who has access to capital, who gets funded. It was just looking at gender, so it wasn't looking at all the dimensions that we're talking about, but it was looking at how they were kind of surveying a group of investors and how they interacted with men founders, how they interacted with women founders, and how men were often asked questions that were more about growth and potential, aspiration, ambition, vision, all the really exciting, fun things to talk about that let them kind of show off the potential and possibility of what they're working on. Women tended to take questions more about the risks, what would happen if they didn't meet milestones, contingency plans, those sorts of things. And so it didn't put them in the same position to show off what their ambition, vision, et cetera, was. And so the output of that study was that more men got funding than women. And again, I bring it up because I don't think those investors went in intentionally trying to put their bias out there and be biased against women. And I think men and women investors showed that behavior. It wasn't just men investors, but I think really important to I was like, wow, that's very poignant, and it's also very practical. And so if you're showing up as a woman founder and feeling that way in pitches, being able to not necessarily like maybe call it out directly in the moment, but being able to change that narrative so you're talking about the things that you want to talk about, the potential of the populations that you're serving, I think that can be really powerful. So just like a really small example of how implicit bias really does impact some of these broader trends that we're seeing.
You said that was a Harvard study?
Harvard Business Review. I'm sure I can dig it up somewhere maybe before the end of the call so I can drop it in the chat. Yeah.
That would be great. So to go back to your presentation, you had a slide talking about who's venture backed, who isn't, and your categories were white, Black, and Asian.
Yep.
And we've gotten some reaction as to what about other groups and ethnicities. Maybe you can speak to that a little bit.
Yeah, absolutely. And I realize I should drop the link to the full report, which I will do. We did ask all folks who took our survey, which included founders as well as leaders of digital health companies, to self-identify across a number of different demographic factors. So race, gender, sexual orientation, where people lived, and then trying to cut to the data to show some of the trends like the ones that I showed. When it came to groups, specifically, I believe people who identified as Middle Eastern, people who identified as Hispanic or Latinx, people who identified as Indigenous, Native American, Pacific Islander, those groups, and this says a lot in and of itself. Like, we didn't get a large enough sample size to be able to report on data specific to those groups. So while they would have been represented in some of the broader cuts that we did, we weren't able to hone in on, for instance, Latinx women founders, just because the N would have been so small that we didn't want to put out a signal into the world that wasn't sufficiently supported. And so that's why we kind of explicitly reported on those groups that had a sufficient N for us to feel confident that the trend data was a real signal as opposed to a one-off from just a handful of people. But I think that's very telling that we didn't have enough, there weren't enough kind of Middle Eastern or Latinx founders, men and women, who took our survey, building digital health companies. That doesn't mean they're not out there. I think there's obviously like response bias built into who saw the survey, who decided to take it. But that is kind of the reason that those groups weren't explicitly represented on that slide. I would venture to guess that the experience of people of color represented on the slide may be similar to the experience of some of the groups that I'm talking about, but can't say that was supported by the data just because we weren't able to report on it.
Got it. And I'll stick with you, Megan. Back to your presentation, presented phenomenal information. There's an incredible surge in interest and adoption and investment. And I guess the question that always comes up is all this investment activity a bubble? In other words, is this activity sustainable in the next 2 to 3 years? What is Rock Health's view on that?
Yeah, we're starting to think about, like, what are the rate limiting factors? When you have so much capital going in, what would be the rate limiting factors that would not allow that innovation to be adopted and scale in a successful way? And it's a lot of things right now, honestly. So one is talent. There's like fierce competition for talent right now. And I think those companies that are able to put the right diverse teams together are going to have such an advantage. Two is, like, I think there was a lot of talk about this recently, is just engagement, right? Engagement and measurement of outcomes. Are people sustaining their utilization of some of the solutions that we're talking about? And is that having the intended impact? I think that's really hard to get right, and not a lot of companies do. A third is just the ability of the industry to adopt innovation, right? Healthcare enterprises are not necessarily known for their nimbleness. And so the ability to like digest, absorb, pilot, scale the innovation that's coming out can be really taxing on organizations like health plans and health systems and pharma, who are trying to wrap their arms around everything that's coming out and integrate it into their business. So their ability to adapt change is going to impact kind of the pace at which funding can be sustained. And the supply of providers. I think, Andre, you pointed out that software can be an enabler, but it's not the be all end all. And so having people who are supporting these solutions, many of whom are in rare supply right now, is going to just be a limiting factor for some of these companies that are going to rely on, you know, mental health specialists, other clinical specialists to deliver care, whether it's in person or virtually. So I know I'm not directly answering the question, but those are kind of some of the factors that we're starting to dig into of, are these rate limiting factors going to start to put pressure and maybe we'll see like a market correction when it comes to the pace of funding right now. Lisa, I saw you unmute, so I'm curious if you wanted to jump in too.
Well, I think,
please weigh in.
The rate limiting factor is going to be, can you exit? Because if you put hundreds of millions, billions of dollars into companies and they can't find their way out at some point at a value that is commensurate with the investment, so you can make return on capital, there's going to be a pullback from that. And there's, no clarity, and nobody will ever know in advance whether the stock market's going to continue to be as frothy as it's been. But it can't go up forever. So, I think that'll be, as it always is, a rate limiting factor on investment. I do think that also some of the consolidation will be, because I think there's going to be, there already is a massive amount of M&A going on. And that will take attention away from new investment, I think, potentially. But it's interesting. I mean, what we've seen, of course, is, not so many more investments, just much bigger ones. And so it will be interesting to see how that continues. I really wonder in some of these cases whether there's a potential return that could be realized given the rate of capital that's coming.
Andre, Michael, want to weigh in on this issue?
Michael.
Yeah, I guess I'll just add that ultimately what you have to come back to is, are you building a sustainable company? Are you creating substantial clinical value? And do you have a business model that works, right? So coming back to those fundamentals and ultimately, I think the companies that win are the companies that understand fundamentally Andre's point that you can't just use technology, right? Like healthcare is human-centered. It has to be that way. But companies that figure out that beautiful blend, right, to create less of a visible seam between tech and human, I think are the ones that have a shot. And then obviously the ones that figure out the business model. And this is, again, the point around having people on your board and on your leadership team that deeply understand healthcare.
Andre?
I think everyone else covered it beautifully. Thank you.
Awesome. So I'll go to Lisa with this question. A lot of the digital health adoption we've seen, this is again from the non-investment perspective, was fueled a lot by waivers and flexibilities that we saw implemented during the height of the pandemic. Medicare, Medicaid, states waived all kinds of licensure and other requirements. What happens to investment in this sector if many of these waivers and flexibilities are rolled back, as we're starting to see in the states, and which likely will happen unless Congress acts at the federal level?
That's a great question, and I think it's an important one too. I think were it not for all of those, emergency use authorizations, and which I definitely think will slow down, and without all of the telemedicine sort of rule relaxation, we would not be where we are right now. In many ways, good, in good in many ways. I suspect that we will see some rolling back. The provider associations in most states, I don't think anything's changed about their reluctance to have people from other states operating in their state. So we'll see how far they're able to pull that back for people to be able to operate across state lines from a telemedicine standpoint. And that will be a rate limiter, and for many companies, if that happens. I also, think we're seeing more reluctance to continue paying for certain types of telemedicine, like texting, for instance, has already been controversial. Most people think of it as video, and not everybody has access to video, so that's sort of an interesting thing as well. And emergency use authorizations have been used to allow for many products, especially digital health products like digital therapeutics and the like, to be released to market without full-blown FDA authorizations. And that, I suspect, will completely roll back. Now maybe there'll be some grandfathering of things that have already been released, and maybe there won't, unclear. But it's going to slow down the path to market to the extent that it was already, previously slow from a requirement. I don't know that that's such a bad thing, frankly, because the process of, if you're going to provide something that's clinically directional, like if you something that tells you to do something clinically or medically, that I think it should be reviewed by the FDA. I think it's a plus for patients mostly. So it'll be interesting to see how that plays out. But all of those regulations, are highly relevant. It's funny. It's always the case in healthcare that regulatory change drives business opportunity. They're intrinsically intertwined, and they always have been. And I think, this is no difference. It's just the opposite direction of usual. So we'll see how that goes.
Andre, would love your perspective, given Lisa's comments, given your past CMS background.
Sure. Yeah, sure. I think there is an incredible amount of noise that legislators and regulators have to sift through. And I think we as an industry, industry may be overcalling it, the few of us that are investors that really are using the investment vehicle as a means to implement social change, we need to work together in a much more coordinated way. I will give you an example. If you look at the physician fee schedule that just came out yesterday, there are, I still have to read through in greater detail, but when the proposed physician fee schedule came out, there was a change that happened that said that a highly evidence-based intervention, virtual cardiac rehab, was not going to be reimbursed after the public health emergency. And it's not because CMS is dumb. It's not because they don't have experts internally. It's because they have so much work to do to sift through all these enormous changes. And some of my colleagues and I, we got together and we did a full court press. Everything from getting our friends on the Hill to write letters to the administrator, to speaking with the administrator, to speaking with the lieutenants of the groups that actually write the physician fee schedule, to writing the comments and making sure everyone was aware of the science, the implications to health equity. And then as it turns out, CMS knows what it's doing. It ended up changing that proposed rule so that virtual cardiac rehab is now reimbursable. But that took an immense amount of coordination just for one tiny impacts hundreds of thousands of Americans, but one little line in a 1,000+ page rule. So I think if more of us on the regulatory side, or no, investing side, that understand the regulatory and innovation side work together and say, here's the prioritized list of high equity gap, innovation and regulatory gaps, and coordinate our activities so that the legislative and regulatory environment creates a fertile and equitable innovation environment, then we will all be doing our jobs. I am open to talk to anyone who is an investor that or in that sphere that wants to collaborate on an equity-related legislative or regulatory gap. I will put my email in the chat.
Speaking of the chat, there have been phenomenal comments made in the chat, a lot of links to incredible source material. So I would advise everybody to go in the chat and get that information. Megan, Michael, anything to add to what Lisa and Andre spoke about in terms of regulations impacting investment?
I'm going to leave that one to the experts, which I think they both are. So,
the point around sifting through a lot of data. I mean, it is so important to remember that, this pandemic has really enabled us to do an amazing number of experiments that would have never happened otherwise. And so the beauty is you cannot ignore the increased access, right, that telemedicine has enabled. You just can't ignore it, right? So once you know something, you can't unknow it. So while I believe, there may be, right, some rolling back, I think clinicians, right, who look at patients every day and see, right, better outcomes will advocate. I think advocacy groups will, right, patients who have had increased access, right, their voices will now be heard because we were able to do this experiment. So I am optimistic, but the pace of change and the challenge therein is real. And so it is, right? So companies that sort of figure out not just the business model, but how do you tee up a regulatory, right, slam dunk that doesn't exist, but right, how do you make it easy for people to say yes, right? It is collaboration, it's thinking through these pieces, and that's where the opportunity is.
So Michael, sticking with you, when we think about digital health, and sometimes it's reliance on connectivity, digital health literacy, just to name some examples, there are some people, particularly on the Hill, who think that digital health may actually deepen existing digital divides. What's your opinion on that? Is that something that we ought to be concerned about? Do you think it's overstated? Where do you fall on that? Yeah,
no, I mean, look, there's clear evidence that technology advances exacerbate, right, disparity. So it's more about, I think, how do we limit the impact of that, and how do we design right from the start, knowing that those disparities already exist. And, you know, I mean, I think I keep coming back to what we learned about even just the grocery delivery business, right, which is booming. And, you know, the thought that people can leverage their cars in ways, right, and their driving ability in ways that we hadn't thought about. And so I think we are on the cusp of a lot of solutions that are relatively straightforward, like, right, delivery. Oh my gosh, that's an access issue, right? And so, but then it becomes important to then think about a more comprehensive solution, not the point solutions that work in kind of commercial pay environments, right? Or self-pay, right? For those of us who are more economically privileged. So I think, you know, the idea of creating multiplexed, if you will, solutions that solve, you know, a greater percentage of a problem will be how things move forward.
Got it. We're mindful of time. We have about 4 minutes. We've got some questions in the Q&A. One is, how are you measuring return on equity specifically? Andres, Lisa?
Yeah, the ways that the institutional investors whose behavior we want to change will understand IRR and regular old ROE calculation. And I think the IRR is particularly relevant because everyone now is looking at the stock market and saying, oh, wow, like this is, we've already priced in all the growth we're going to price in. They're looking for other investment vehicles. And, you know, when you can compare a flat to maybe 4% stock market traditional equities approach to a 40% IRR investing in the bottom of the pyramid, granted, it's mostly venture, relatively high risk. You need to have good access to deal flow. Like, come to me and institutional investors, I'll tell you some great deal flow. You know, like I'll give it to you for free. Here you go.
You know, I think, you know, well, I agree with Andre. These, you know, first of all, no money, no mission. So if you don't, the companies don't sustain, they don't deliver. But I also think that a lot of companies are, you know, a lot of investors have different things they're trying to measure. Are they having impact on more people that are, you know, in the buckets of your categories they're trying to impact? Are they, you know, making care more accessible as measured by people who get turned away, or who, you know, timelines or other types of things. So I think a lot of it has to do with how, you know, the investor or entity they're selling to care, what they care about. It might be hiring, you know, numbers. How many more people of color did we hire? How many, you know, how equitable are salaries at this point versus last point? So it really depends. But in the end, when you're thinking about it from an investor standpoint, a traditional investor standpoint anyway, Andre is straight up right.
All right, that's great. So I want to bring us to a conclusion here, given we have 2 minutes left. So in 30 seconds or less, and I know this is probably being unfair, we'll start with Megan. What are you excited about when you think about the landscape 1 to 2 years out? And what gives you some trepidation or some doubts about investment health equity moving forward?
30 seconds. I'll speak to something I think Lisa brought this up earlier, of kind of the, you know, this trade-off between building for the masses versus building care that is going to be, you know, built for a particular group, a particular population with specific needs. I think we are seeing some more of that in the earlier stages. And I think there's a recognition among some of the larger platforms of integrating those solutions into what they're doing. I mean, you saw, you know, one example was Doctor on Demand, Grand Rounds creating a larger platform and then bringing Included Health and now taking on that name as an example of that, where Included Health really building telehealth delivery for the LGBTQ plus population. And I think that larger organization realizing for us to have impact, like we need to have more culturally responsive care. And so I am excited that we're starting to see that integration of platforms that are kind of at or reaching scale, but also with an acknowledgement that they need to go deeper and build out offerings for a particular population. So that's really exciting to me. God, some of the rest, a lot of the things that we brought up on the calls, but on this call already, but I would say kind of this, this the importance and continued focus on elevating voices, founders, innovators that historically haven't had access to the same networks and capital historically.
That is phenomenal, and unfortunately, that's going to have to be the last.
Oh gosh, sorry guys.
That's okay. No problem. No problem. We're right at time, and if you can see there, we've got 2 sessions that are scheduled at 3 o'clock. So please join us for one of the 2 sessions. And thank you very much, panelists, for an incredibly informative 1 hour. It went by very quickly for me. So thank you very much.
Thanks, Renee.
Thanks, Renee.
Bye.
Thanks, everybody.
Bye, everyone.